Welcome to our new issue of the Grey Market Talk with former retired market maker Thorsten and portfolio manager, chief investment officer, and simply market god extraordinaire, Nic I from his hideout in, I don't know, Frankfurt, London, all over the world. Nic, thank you very much for joining me this morning. I see you've left the putting green to shoot a little video.
Well, you can never get enough putting practice, and if we want subscribers, golf has to be part of this.
We mentioned that, didn't we?
Absolutely.
So what I want to talk about, I'll start with something easygoing because I was a victim to my YouTube addiction. And I saw a lot about I had to write it down. That's how old I've been, because I said, go woke, get broke. And I was corrected. It means get woke, go broke. And there are a couple of really, really nice examples out there. We all have heard by now, you've heard about it as well, I guess, about Budweiser with Dylan Mulvaney story. I had to look up who Dylan Mulvaney actually is. Dylan Mulvaney is a transgender activist who has transformed, or I don't know, you correct me if I get the language wrong, and everybody forgive me if I'm not using the right words, into a woman, and has celebrated his 1 year of womanhood and became a testimonial for Budweiser, for Bud Light. And that went horribly pear-shaped. And the interesting thing I thought when I followed this whole thing, Budweiser has lost now 30% in sales. And they got this, they called it the Star of Death at Costco, something new I had learned. Products that are being delisted once they are sold out get a little asterisk on their sales number. And apparently Bud Light has now this Star of Death at Costco's, which is a real disaster. And then I started thinking about, are people really angry about Dylan Mulvaney? And I thought, no, of course not. He's a nice kid, yeah? Getting a commercial for Budweiser to attract the diverse crowd. I think the next step was the real killer. They had this lady who was responsible for the marketing campaign on a leaked Zoom call video or something like that, because they're not doing it like we do, live on TV, internally. And she was actually rubbishing the whole customer base. Yeah. The fratty boys not having fun. I think that really cost Budweiser their customer base in there. And that made me think, okay, obviously we have this scenario now. They lost big revenues. People are simply not buying their beer anymore. Then you have the next candidate, Disney. Eigner just got his contract extended for an additional ridiculous, I don't know, 40, 50 million US dollars. And they've now managed to actually ruin all the, from us, beloved franchises they have out there, besides Guardians of the Galaxy. Last movie I watched was really good, but they managed to ruin Marvel. They're not getting the whole DC Superman empire going, and people are refusing to watch of our generation, Indiana Jones, completely tanked. Production costs 600 million, marketing costs 350 million dollars. So you're talking about $1 billion asset, which is most likely never going to bring its money. Nic, is there something to it? Is the market shifting? Is the market noticing? Oh yeah, maybe one point. The US presidential candidate, Indian chap, or Indian sounding name, I forgot his name. He brought a fund to Wall Street almost a year ago, which exclusively is investing into non-woke stuff, in fiduciary rights, in profitable business. Is there a change in mind shift, or is this going on a little bit further until we've ruined everything? Well, I always say that's why we can't have nice things. Is that the first sign of hope that we're going back to profitability, or is this whole woke thing still rolling through our industry?
Wow, that was a hell of a lead. These are not my expert topics. However, I mean, this is socionomics. Yeah, this is about how people are behaving in society and how society is shifting. And I think society has kind of had a go at doing something a little bit more extreme, put it this way, than where we've been in the past. And historically, these are signs of major changes in economic progress. Yeah. And it could well be that this is marking some kind of major change. Could be a, change in the currency, could be something that's going on. But the fact that there is a lot of, how should we say, pushback from people on this thing tells you that perhaps these companies are going too far. I mean, you just named some of the Marvel and Disney things. There was a film recently, and I'm a big fan of the Marvel stuff and whatever, and it was Ant-Man and the latest Ant-Man. I never watched it to the end. It was so bad. I stopped. I mean, it was just the wrong type of film. And you have to understand, I think, there are people who are experimenting. James Bond, they killed off James Bond.
Yeah.
I mean, now either you and I are just too bloody old, and this grey market, we are really sort of the old generation, and we're going to be sort of wiped out eventually. But I think that they are going to the extremes, and I think it will cost them dearly in the end.
What I focused on was actually what made my research going. I read a little article, and now we're suddenly back in Germany with one of the biggest car producers in the world, with Volkswagen. In the first 3 months of this year, Volkswagen produced just above 90,000 electric vehicles. Guess how much they sold? 75,000 of those. So if you want to have an electric vehicle by Volkswagen, the biggest car manufacturer out there, you actually get it pretty much immediately. Not like you wanted to have a Tesla a couple of years ago and you had to wait a year or a year and a half before you got your fingers on one. Now Volkswagen has real problems flogging this stuff. I understand that, where it's coming from. Yes, energy prices have gone through the roof. People realize that somebody remotely could switch your car off if they can. But taking that a step further, and why did we start with Dylan Mulvaney here? We're talking about economics and the implications of that. And what went through my head, I'm still waiting for the next shoe to drop, for the big recession coming out. We had a pre-talk about, and my my weird theory that we might even think about a depression. Nick will rip me apart for that later. But what I'm saying now is Volkswagen wants to change their whole fleet to produce EVs till, I think, 34 completely. And they can't even sell the stuff they have out of production facilities right now. What does that implicate for the German economy, for the European economy, and for the rest of the world? And that's when I'm clipping in now the slides about China, because for the first time we're recording this on a Sunday, and my German podcast is also recording a little bit later. So for the first time on a Saturday, I had time to read the Financial Times again, the weekend edition, and that actually showed me some laugh out loud pictures, which I thought I have to quiz Nick on those. And one of the big laugh out loud was this: Beijing plays down the threat of deflation. And what made me laugh was turbulence normal for post-pandemic recovery, says central bank official. How many data points do they have correlated to pandemics and how markets usually react after a pandemic? What is the relation to deflation, inflation, and economic recovery? It's like they're pulling it out of their backside, aren't they, Nick?
Well, again, let's just one sentence really on BMW. When car companies
Volkswagen or BMW?
Was it Volkswagen? I think you said.
Yeah.
When Volkswagen used to make decisions on cars, they'll research what is needed. It's driven by the consumer. They add their technology, but this time, decisions on what to make are driven by central government somewhere. And this is not a decision from a company that was trying to maximize their stuff. This is something driven by legislation, and this comes back to the points we've talked about in the past about an increased command and control over the economy, and now the car company is being told exactly what to make, and it's obviously you're going to get this disconnect with the demand and supply thing, because that's not their game. The game is they're forced to sort of turn their combustion engine production into battery production and cars, and it's not going to work initially. And as I say, anything which is centrally planned, anything which comes from government of whatever description is never going to work. And then we come down to this thing, Beijing placed down the threat of deflation. Well, here you have a real centrally planned economy, right? I mean, they do control things dramatically, but what you see is that since the global financial crisis, where they actually did not bad, whilst the West was struggling, growth in China has been in decline, and more so now that China is actually in a deflation. So, and they're struggling because the real estate collapse from last year, they still haven't got over that. And they've spent an awful lot of money in the past years creating these kind of cities where nobody lives. That's why they're blowing up the buildings. We spoke about that. Cities where nobody lives, roads to nowhere. They had a lot of, capital formation, if you like. They had a lot of investment in their economy, but that's not where the growth is coming from in the future. And so whilst they reorient their economy to the consumer, perhaps increasing their exports, they're going to struggle. And right now, this plays down the threat of deflation. They can't play it down. This is a serious problem. The Chinese currency was falling. And the Chinese currency was falling so fast that they got rid of they swept the floor of the PBOC governor. Now has been replaced by Pan Gongsheng. I don't know if he's been officially announced, but he's the guy, I think, who met Janet Yellen. China has a real problem.
Where all that deep bowing happened, right?
But yes, probably. So this is pretty serious. When China, everyone's sort of played the game. Okay, the China coming out of COVID lockdown, it's got to be good, surely. And actually, it was just the lockdown was just a pause of a trend in China where growth is slowing. They had their real estate collapse. They haven't got over that. They're not making the right economic decisions. The currency has been collapsing. And they met with Janet Yellen. And after they met with Janet Yellen, the dollar falls and the Chinese currency recovers. And part of this thing, in order to support the currency, what they did was they stopped actually pumping liquidity. I know you're going to ask me about liquidity. They stopped pumping liquidity into their market, which gave a pause to the fall in the currency. But now that the dollar is falling, so you don't know whether they made a deal, that the dollar should continue to fall in order to give the Chinese room that they can continue to pump liquidity in order to get themselves out of deflation. So if they don't get themselves out of deflation, global growth, question mark, and the rest of the world, especially the US, who need growth to get out of their sort of sovereign debt problem, which they've got, they've got to work together. And so it may well be that's actually what's going on, but they can't play down the threat of deflation. Deflation is kind of there. Prices are falling in China, and they need to do something. And the natural response is pump money into the system, support real estate prices, reduce mortgage rates, which they failed to do with the previous governor.
So the reopening trade has fallen flat on its face, which everybody was trying to shove down our throats for the last 9 months, you could almost say. I was very, not enthusiastic about this reopening trade. And one of the interesting points I want to mention, especially to China, it reminds me bloody eerily about what happened to Japan after the golden years. And the final nail in the coffin, I listened to an interview with Richard Koo last week. For everybody who doesn't know Richard Koo, he is the legend, let's call it the inventor of the balance sheet recession, which we also mentioned on this program before. He's heading up the Nomura Research Institute and one of the finest thinkers in the market. And in this interview, Richard Koo said he is consulting like crazy at the moment in China. Why do they want to speak to an expert on balance sheet recession? Who experienced that in Japan, who wrote intelligently about, who had solutions for it all. And now you just mentioned the points. Yeah? The property bubble completely deflated in China. They have deflation is a real problem there. And they have Richard Koo trying to give them good advice. Unfortunately for all Chinese people, he's not a friend of tax reductions. He thinks tax reductions do not help if you have a balance sheet recession, because everything the poor sod on the street does is then he takes his money and pays down their debt. So you can't give him their own money back. If that is a thing, and you just made the arc to the world economy, then we are heading into difficult times. China is clearly out there in the danger of running into troubled times or interesting times. Europe is finishing itself off with Germany in the lead. Yeah. Can you describe it any different? So
no, that was very well said.
To the rescue.
I can't say that. I'm not Germany, so you can say that. You're a German.
To the rescue, it can only be the Americans, right? Save the world again, once over.
Well, yeah, but how are they going to do that? The only way that they can seriously do that is if they let their dollar fall. Is if they let the dollar fall. So,
well, you forecasted that. Maybe I can sneak this slide in earlier because I had it in here. You forecasted last Sunday what's going to happen with the dollar. The dollar had a really, let's call it a bad week at the races. Also, Financial Times.
Yeah, I mean, my view on the dollar has been for a while, but last week was quite exceptional because there was every reason for me to be wrong on that weekly basis because liquidity was tight. You know, the ECB were getting repayments from their emergency funding. You had the MOVE index exploding higher, all sorts of reasons why the dollar should go up. It went down. And I think that sort of told you that, that there's definitely something, you know, underlying weakness in the dollar. And whether this is a Yellen Chinese agreement or not, I mean, one thing is for sure, the dollar cannot stay still this strong. Tax receipts are collapsing in America. And, you know, the Americans also have to cure their problems. So the Chinese have got problems, the Americans have got problems. And, you know, whilst everyone says, okay, that might therefore lead to a recession, yet if they don't do something, it will lead to a recession, correct? And both sides can ill afford a recession. The Chinese do not want 1 billion people knocking on the door of the People's Party and saying, hey, what's going on here? And the Americans can have an election next year. They can ill afford to see some kind of a recession now. So therefore, they have to act. And the first way to act is to depreciate the dollar and to recognize the fact, you know, what we've been talking about since the very first video, that ultimately, you know, there has to be a resurgence of QE. They cannot afford these high interest rates themselves. They have to pump money into their own system. Otherwise, they are also toast. And the elephant in the room, you know, for China, it's the real estate market. And for the Americans, it's their debt pile, which is just exploding now that they've put their interest rates even higher. And they expect another 25 basis points just to say, hey, I've got more where that came from. And very soon they'll realize that they are killing their own economy.
Yeah, well, 7% I read tax receipts have come down in the United States. Sorry, in my playbook, this is clearly an indicator for pending recessions. You always have tax receipts falling before a recession hits the market, actually.
But isn't that strange that tax receipts are falling at a pace which only previously happened at times of recession? And we're not in recession. Imagine now, if we do go into recession, what do you honestly think the state of the debt pile will be? How much do you think that every year these guys will be adding to that huge 32.5 trillion debt, which it is now? It just goes up so quickly.
Yeah.
I mean, what do you think is going to happen? And then they add an interest expense on top of that. Then they add extra deficit because less tax receipts are coming in. And, this spiral has to end somehow. And it's not going to end, in my view, by them killing the system. It has to end by them saying, we recognize that at the end of the day, we're going to have to do financial repression, which is, financial repression is the exact opposite of the policies they followed for the last year and a bit, where effectively they would have to allow interest rates to be lower than the rate of inflation.
That's an interesting point. I'm flicking between our slides, even though we had a structure at the beginning, what we wanted to talk about, but I think it's appropriate. I love to flock the guys whose slides we are using, who are tweeting it about. This is Game of Trades, channel I can recommend, not because of their conclusions necessarily, but they are doing the job we are doing. We're skimming the market for everything that is interesting. And they had a nice slide out there, which is from Bloomberg and National Bureau of Economic Research. And they labeled it nicely, high yield spreads have runway to widen in a recession. Yeah, no shit, Sherlock. Seriously, and if I click then to the next slide, that is from Deutsche Bank, I think, credit research, S&P Global Ratings credit research. This is, we mentioned that a couple of weeks ago for the first time, the credit wall rolling in. And you spoke to me earlier and said that might be one of the most important slides in the whole deck today.
Yeah, I think so. You asked me previously, what do I look at? And I look at these high yield spreads, and clearly price action tells you a lot, and it tells you that you had all of that. You could ignore all of these fears of crash and all of this stuff. If credit spreads are contracting, nothing to see here. But obviously, we can't be blind to what's heading in the future, and why is it that credit spreads are not reacting to an economy that is struggling at the end of the day? Credit spreads are moving in line with the equity. So, if equities go up, credit spreads are going down. That kind of makes sense. These companies are in good shape, but they're in good shape for now. And I think you need to kind of look forward. And this is why, one of the things that I say to clients is effectively, whatever you do on credit, don't go and lend to leveraged organizations, or do not, focus on this leverage business. You need to be at the other part of the curve, non-government, high-quality credit. And the problem is that these organizations, up until now, what they've done is they've had a huge amount of cash, and they've got a lot of debt. So the debt that they have issued before at 2%, 2.5%, whatever it was, but they've got cash right now and they don't have to repay the debt. So what they do is they stick the money on deposit account. They earn 5% on that. So they are rolling in, they're earning good money on their cash. But this, when you look at 2024, 2025, and you start to see that there is a much larger amount of refinancing that's going on, this is the point in time where those leveraged institutions are going to struggle. And we spoke about Thames Water last week or the week before that. Yeah. That was one that already met his problem very early to say, oh, I need to refinance my high yield, private equity finance, clever leverage for the shareholder. And then suddenly they have a big problem. And this slide, I think, is telling you exactly that. Okay, the problem hasn't arisen yet, but it may well come because it's kind of been hidden by these high interest rates people stick cash in. But when they come to refinance, what do? They better have the money ready. And that means that they shouldn't be paying dividends up until, before, unlike Thames Water. They shouldn't be paying dividends out. And, these companies, big question mark. Leverage, I've hated for a while. I hate even more now. And so anyone involved in that stuff better know what they're doing. Yep.
The credit rates here, by the way, here we have the bankruptcy filings. These are companies above 50 million in liability. So it's a bit arbitrary. Game of Trades also worked that or had a point on that, but I just want to focus on the big corporations, because what we are painting here at the moment, and obviously I'm trying to paint you into a corner. You've already smelled the rat coming in. We see a credit event eventually could materialize, especially with the volatility in the bond market going further on. Then we see bankruptcies rising. The other big big influencing factor I'm looking for at the moment is US property market. Especially, well, we don't have to talk about commercial property. It's a big mess anyway, and we all know that. Residential property, 15% of residential property is new builds, and 85% of residential properties are existing homes in the United States. If Joe Average would have bought a house for the mean valuation of $400,000 US and had a 30-year mortgage 3 years ago, he would have paid back after 30 years the $400,000 for his house and $200,000 in interest rates accumulated. Now, if they open up this trade, they pay back the $400,000 for their house, plus an additional $600,000 US in interest rates. That's why people who own a property, who already reside in a property, are not selling, because they have to buy a new place and they have to refinance at a higher rate. The solution for that would actually be very, very simple. Move with your mortgage. Why that isn't a product, I don't know, but apparently it's not a product which you have out there. And the builders are like crazy at the moment. There was a big rally in the home builders producing material. They've already stepped in, the big home builders, by subsidizing people's mortgage payments, which is nothing else than reducing the price of the sales of the new homes. So we have the industrial basis actually could run into the danger of a credit crunch there because it's so high. The private individual out there, the big wealth or the feeling you have a lot of equity in your house that gives you the financial power, at least mentally, to spend more money. The consumers are still spending out there. Yeah, absolutely fantastic. The figures show it. Inflation is coming down, producer prices coming down. You know, we are actually in this fantastic Goldi-Locks scenario, and we see all these little pinpricks. Tax incomes come down 7%. If I look at the S&P without the mega stocks, it's actually flatlined during the year. Yeah, nothing has really happened. Do we already have the situation where this whole thing could blow up, and the leading factor could be the housing market, compared with we're staying higher for longer, and the Fed does what it always does? It will still raise interest rates right into recession to blow this whole thing up.
I looked at housing for a client in January in US housing, and 15% is the is the number that I had at the time as well. The answer to that is I don't believe so. I mean, there isn't, one of the things about housing is it's sort of very cyclical, and there is a hazy 18-year real estate cycle that you can follow. So if you ask me about housing, if we were 2027, I'd say, well, be careful. So on the cycle basis, this is not time. Secondly, these housing builders, Toll Brothers, and all of these guys who are making money on housing right now, how are they making money? So they are making money because people still need to rent, and rental is yielding. So, the new housing is getting so cheap that actually it's actually worth buying, renting out at a huge yield at the end of the day, because the old housing is not coming onto the market. So you're creating a dynamic in the real estate market where actually, what is going to tip that thing? I would say, again, we're back to refinancing. And if people have got mortgages which refinance in 20 years time, where is the dynamic that's going to tip them over? So I came to the conclusion then that real estate was not going to be the issue, at least not residential real estate. Commercial real estate is a different thing, especially with high interest rates. But residential real estate was not going to be the one that was going to kill the market, at least not now. And I sort of said, if the best I could do is look at cyclical analysis, and I came up with 2027 as a cyclical time where real estate is likely to show a fall. So on this chart you've got in front of me, sorry, because you've got it in front of me, I keep staring at it, really. If somebody showed me this chart, right, came tomorrow and said, well, Nic, look at this thing, 4-week moving average of US bankruptcy filings, I'd say, brilliant, let's go and buy the market. I said, well, why that? I said, well, because every time it peaked at this level, the market rallied afterwards. So what's your problem? You know, what the message I think that the chart is trying to say is that there are underlying problems in the market, but it hasn't resulted in a collapse in stocks in any way. So it's a state of the market, but it's not a predictor of anything that that would force me to, you know, kind of act. I am more worried, frankly, about the US debt situation, and for me, that's the thing that we should all be worried about, and we should all be focused about, because you know, the level of interest rates, the amount of debt that there is out there, the level of tax receipts falling, and the level of expenses that are coming from the government. The economy is driven now by the government and everything that they're doing. It's also driven by the interest that they're paying on their debt. So that's also stimulus-like. Or, I mean, when you've got a deficit, the interest you're paying is also stimulus-like. So, you know, there's a lot of screwed up thinking at the Fed right now, and that has to change. And those are things that worry me much more than these status of the market things, which can be repaired with the right kind of policy actions.
Well, that's the point. Then we actually are not in trouble, because as we all know from experience, if the major parts of the economy are in the hands of the state, things can never go wrong. They have prudent thinkers who will always rescue us from the perils of free market capitalism we have in here. No, I'm with you on your analysis. Even though on the housing side, I think it's obviously I'm a bit biased on that side. I used to work at Bear Stearns in 2008 when we blew up, like so many others. And it always starts very, very slow until the breaking point suddenly is reached at one stage. And last week, we all saw the CPI figures. We all saw the PPI numbers. I thought to myself, okay, fine. World is good again. Inflation is not a topic at all. We are fulfilling all conditions of the Goldi-Locks scenario. The banks are making abundantly money. Not Goldman, JP Morgan, Bank of America, Wells Fargo, they came out and said, yeah, lovely, fantastic. We are making money on the interest rate spread, the money we're lending out at higher levels to the funding we take in. So are we in this scenario? Am I still completely blind with all the things I see in front of me? Or is it again a timing factor we have here? I will end up right without any doubt. And now I'm coming to the the outlier opinion. I heard for the first time 6 or 9 months ago by Alex Gurevich, a fund manager, who has very interesting opinions, and funny enough, he always seems to make money with his very interesting outside opinions. He said, yeah, we're not talking about a recession. What we're talking about is a depression with negative interest rates, with real deflation pressures, and this is going to come. And the more I look into the data at the moment and say, okay, fine, yeah, these inflation numbers pointed in the direction to the downward slope. The economy worldwide, we had China on the plan, we had Germany on the plan, we had the US now on the plan. If we drift into a global recession, what doesn't stop the market actually to dip into this scenario where we end up, because that's the only solution governments seem to have, let's print more money and control the financial markets. I want to buy long duration bonds now, not equities. I want to start building up a huge portfolio. And you promised me in our pre-market talk, you're going to rip me a second one for this. So help yourself, Nic.
Well, you know, it's very rude to, you know, you are the host. But the problem with bonds is the following, that in the world that you've just described, where it's clear we've got debts increasing every year, tax receipts declining. What is the job now of the central bank? The job of the central bank is to make the treasury, the government, look solvent. Their job is not about growth. It's not about employment. It moves from all of these factors to just saying, the boss, the country is solvent. You know, the Americans have this privilege that they can continue to do what they're doing. I mean, you know, there's no way that Argentina or Turkey or anyone could do what has been going on up till now. Just continue to increase your debts And so, yeah, it's okay. We put 5% interest rate, so we're 32.5 trillion, and we know that's going to 50 trillion in 10 years' time. It's okay. Trust me, in God we trust. But unfortunately, the job now of the central bank, it's got to the point where, and this is why, the dollar is falling, and why you need to rethink about how you kind of manage your way over the next years as an investor, is to say, well, these guys have only one duty, and that is to buy this stuff from the government, because who on earth, apart from Thorsten Wegner and the Fed, are going to buy government bonds? Because the Chinese will not buy them, because, well, let's just say they're not as rich as they used to be. Their exports, they have a strong export economy, but it's just not enough, right? The Japanese have got their own issues, and they would rather repatriate their US dollar holdings back to support the yen, finally at the time where their economy needs capital. Up to now, they've given the capital to the Americans over the last 30 years. They don't do that anymore. They need the capital at home because their economy is starting to grow. So for all of these reasons, and geopolitics and all of this stuff, it's not going to come from Saudi, or it's not going to come from Russia anymore. So where is it going to come from? So the only people it could come from is by forcing institutions, pension funds, insurance companies to go and buy their treasuries. I mean, you could do that. And obviously, if you force these pension funds and so on to buy the treasuries, they can't buy stocks, where you can't, the banks, maybe they can force the banks to buy treasuries as well. But the trouble is, if they force the banks to buy even more treasuries, then the banks got less capital, if you like, to lend out to the economy. So that's not good. So the only, conclusion that you come up with is dollar down, Fed continuing to buy this stuff. And what the hell would you want to be long of government bonds for? Because at the end of the day, there is a real question mark for me as to, I would rather buy short dated, but I would worry about the solvency of an economy. I wouldn't know whether yields are going to finish much higher, because people realize actually what's going on is a kind of a hyperinflation, where effectively they've got to inflate their economy in order to get their debt down to a manageable level. And it's much too complicated for me to kind of untangle all of this stuff and say, therefore, yields at the long end have to be lower. I don't know that that's really the conclusion I can come up with. I can say for sure that they can't afford higher interest rates, so short yields have got to go down. But I honestly have no real conviction about whether or not yields at the long end will follow. You've already got a huge negative term premium anyway in the States. That's why you have this negatively sloped curve you have today. And I would say, negative premium is about 70 odd basis points. There's 70 basis points worth of something expensive you're buying, right?
Maybe make 2 points here. First of all, obviously the dollar decline we've seen last week, I think that must have been us with our new monetary world order, which we discussed on Sunday, which might have raised a couple of eyebrows of the really big boys who obviously are listening to us, and did a bit of front running on our opinion. Second point is, you just asked me, so okay, it's only Thorsten and it's the Fed who are buying the bonds. Yeah, I'm absolutely happy with that. The Feds are the guys the Fed are the guys who print the money. Yeah? And at the end of the day, when this economic scenario kicks in, they don't care about the consumer. They've never cared about the consumer. They will do yield curve control. There will be a real inflation in the market, which will be much higher because they can't produce stuff, but they simply keep buying the whole curve, and they're going to buy it down, 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 because they have the money. And as long as the US dollar is still the world reserve trading currency, they don't have a problem with that. So me looking at the market right now saying, yeah, fine. I'm actually happy if the guys who manipulate the market, and not in an illegal way, but in a positive way, because they can print the money, if they at one point are being overwhelmed that they have to stimulate and have to reduce interest rates to actually get into your scenario, they can't allow the market to blow up. Interest costs are already high as they are. That's what they have to do. And I want to actually piggyback on that trade to say, yeah, fine, I'm going into bonds. I see all the economics scenarios you build up here, but what I'm interested in is more, will I make money on my investments? And if the guys who are pushing interest rates down and therefore bond prices up, and they are doing this without knowledge, brain, or whatever, just because they have to, that's the trade I want to ride.
It's a fair point. And it's a trade. You keep using the word trade, and that's right.
Yep.
Bonds are a trade. In my view, they're not an investment. And you may well make money in a short time horizon for, you know, a drop in yields from, let's just say, 4% down to 3.25% in a 10-year. You know, trade is fine, but investment is not fine. And you use the term yield curve control, which will absolutely right. It will happen. It has to happen because, you know, if the market kind of figures out that they're setting this yield curve control at a level where, they want inflation to be higher than the yields, well, they're just going to raise the yields. So the Fed have to come in and say, no. We cap the yields at, I don't know, 4, 3.5, 3, whatever that number is. Let's just say they have to cap that level in the same way that the Japanese are doing today. They have to cap the level of where the yields can be, where they can afford it, but they want inflation to be higher. And on that basis, when you're buying something, let's just say they cap it at 3%, they cap it at 3 and inflation is at 4. As an investment, you're not doing so good because the money that you are saving for the future of your investment here, you know, when you come to spend it at the end of the day, you're going to be buying stuff that you won't be able to afford. So clearly, this is part, I think, of the rationale right now, where people are saying, well, look, if I look at the valuations based on a historical basis, you know, this is the worst. You know, I've seen so many people on Twitter, and they're not wrong. The analysis is absolutely correct. But there must be a dynamic going through the mind of people right now to say, why am I not using this money to go and buy bonds? Well, perhaps I'm more fearing the inflation trade. Now, and here's the complex bit. I don't know whether equities are necessarily going to do particularly well in an environment where you've got, again, runaway inflation. But here's the thing. If they cap yields as they did in the 40s, you know, what kind of return did you see on equity versus fixed income? You saw equities give you a 6 times multiple versus what you earned on treasury bonds. And on that basis, if you think about the sheer size of the fixed income market versus the size of the equity market, well, that just says, you know what, you only need a small amount of reallocation from fixed income to equity to suddenly create, a balloon. And coming back to all of this analysis to say, oh, look, if you buy an equity now and you hold it for 10 years, you know, you are going to get the worst sort of net return over 10 years in history. And you know, my answer to that may well be, but that just means I don't hold it for 10 years. It may mean I have to hold it for 3 because I might make my money over the next 3 years, because this shift from fixed income to equity may mean that over the next few years, you see stupid, really high returns in equity. But over 10 years, you know, this thing kind of evens out, you know, as people kind of who didn't get in, they buy the top and then it all comes crumbling down. But, you know, this is perhaps what we're seeing now is a realization from the market that actually, you know, fixed income is a really dangerous thing, even at a 4% yield.
I think you made a fantastic point right there, because that is something which is in the back of my mind. You know, we're always trying to divine where equity markets are going. But we always forget in this whole analysis, equity market is per se the leading indicator, actually. And we have this earnings expansion we can see. Schiller ratios, I spoke in another video about that. That could be actually a very, very good indicator for the case you were just making. Why do we see these expansions? Earnings are not really fantastically up. They just are beating the revisions which came in on a lower level. However, the expansion of the PEs is there. It is clearly to observe. That would fit in with your scenario that the equity market as the leading indicator actually gives you exactly this scenario. Yeah, and in a way, we would both be right. Interest rates will be very low. There will be real inflation. Everybody knows it's going to happen. What's your best protection against that when you want performance? Well, you go into an already overvalued equity market, because the PE expansion will prevail, at least for a time, and you don't have to hold it the whole 10 years period. And then we would square the circle with our differing opinions.
And of course, you and I are talking as if the only investments on the planet today are S&P futures or treasury bonds.
Yep.
And the reality is that, now and before, you need to be looking at other markets. And I sort of seriously feel that with a weaker dollar, you're going to get commodities, with a bid. You're going to get emerging markets with a bid. Emerging markets don't have a problem of the huge debt part. Not all of them anyway. They're not all Argentina. That, you choose the right emerging market. You know that the Asian market's going to do well, but perhaps not China. But, other markets in Asia are also interesting. So you now need to widen the net of the things that you used to look to in the past, which were probably, DAX and S&P or NASDAQ, right? Well, now you've got to broaden your horizons. Now you've got to look at Japan. Now you've got to look at Asia. Now you've got to look at some emerging markets, maybe some emerging market fixed income. But, the sort of portion that belongs to the American region probably is going to be a little bit less.
You just mentioned commodities, and I think because we barely talk about commodities here on this channel, not because we don't love them, but I always thought we have to do sort of a teach-in. I thought that would be actually quite interesting next week to benefit from your experience, to give sort of a primer, kind of a deep dive. What is actually in a commodity cycle? How does it work? At which stages in time in relation to the US dollar, in relation to emerging markets? When do you go long? When do you go short? When do you do nothing? Would that fit with your schedule, Nic? I think a lot of my students would be interested in your know-how there.
I will do my best, but now you talk about commodities, and you brought it up, so I will mention it. You spoke to me a while ago about copper. Right? Yep. You say, oh, look, copper is really, it's going down, man. The economies are all shit. It's, you've got to lose this stuff. Copper's starting to go up now at a time when you're saying the economies are even worse than they were when you were. Yep. And you have to think about the price of this thing is now a dollar into play, as opposed to just, the use of copper. So commodities did get a bid this week, a little bit from the weaker dollar, not gold, but some of these other commodities. So oil didn't do so badly. It's still not at a good level, but okay, we'll find a time probably next week to talk about it.
Let's have a look at that, especially after we caused the dollar decline with our little podcast. Let me have a last look on market sentiment, and then there is one more chart we discussed earlier. We are still in the territory of extreme greed, and prevalent opinion seems to be we are still climbing the wall of worry, even though after last week's figures, what are the worries? Is there still something to worry about? Everything looks so nice.
Yeah, I mean, what they're worried about is, well, hang on a minute. They've been turning the dial full blast on interest rate rises, right? I mean, nobody can argue with that. They've tightened in the fastest pace ever in their history. So they're on full blast at the moment. And inflation levels have been falling at an increasing rate. So are you sure that this thing you'll be able to catch this thing at 2, and then you'll be fine? Or perhaps you might have done more damage somewhere else that you're not looking, like money supply. We talked about money supply. The money supply has perhaps contracted far too sharply, and perhaps inflation may just go all the way. And you won't be able to do a damn thing about it, because you're not going to cut interest rates from 5. You're not going to say, well, now I cut them from 5 to 3 or something because we're at 2. I'm afraid to say that this is a real thing to worry about as well.
Then maybe the last chart, which is actually confirming your opinion, not mine, as you told me earlier, but you can do that again on air. Jesse Felder posted that, and he got it from a tweet of Hulbert Ratings. I've never heard of them, and I don't know the details of the indices, but what it says is ominous parallels. Average recommended equity exposure levels among short-term stock market timers. We are in the region of trade, and we're in the region of timers, and what we can see here in orange is top of the internet bubble in March 2000 as a line, and we have the level of today. So in short, everybody says, yeah, we should now put more and more money into equities and less into bonds. Whether I'm on the short-term side, say, yeah, fine, I'd rather do the opposite, but hey, what do I know? Nick, tell me again, why am I wrong with my philosophy, especially if we look at this chart?
Well, again, the way that I sort of focus on stuff, when people sort of show me this or I see it on Twitter, I would go straight past this thing, because whoever it was who tweeted this thing wanted to make a point, perhaps they're bearish or whatever. And so they show something, and it's easy to come up with these things. So that's the first thing. And this looks like one of these tweets that I would just scroll over. But nevertheless, the point is here. If somebody wanted me to talk about it, you do want me to talk about it. Is this the point again about, well, is today the first time in the history of this analysis here, I don't know how far back this thing goes, where you say, well, actually, we're in a different world. We're in a sovereign debt bubble. Where on this thing, on this orange line, were you in a sovereign debt bubble before? And if the answer is you weren't in one, well, then I don't want to look at the chart. We are in a sovereign debt bubble. And for that reason, the way that people have to think about their investments has got to be totally different to the way that they thought about them in the past. As I say, it's still, the jury is still out how well equities will perform in an environment where you let the inflation genie back out for a bit. But if you are to cap interest rates, and if you were to have yield curve control, that arguably they could do quite well. And so for the people who are doing the today bit, maybe they're the people who are reducing their fixed income investment and going into equity for a different reason than any time in the past of this thing. So I hate to use the word this time it's different, but my guess is on this chart probably is different.
Famous last words. Thank you very much for that.
Yeah, I hate that.
I was able in, almost an hour to extract this time it's different. Finally, I got what I wanted.
I knew you trapped me.
Nick, we've down 50 minutes. Perfect timing today. Famous last words always to you. You're scanning the comments or anything you would like to add.
There were no comments other than I think I need to learn German. But aside from that, don't think that anyone had any real questions that need answering desperately.
Lovely. Then let me thank you, and let me get you back to your putting on a Sunday morning.
Many thanks. I need the practice.
There are more important things. I'll get another coffee, and I'm going to shoot my video with Marcus in a minute. And for everybody who hasn't seen our last week's edition of Grey Market Talk, where we actually talked the dollar down, very interesting about the new world trade currency. I'll put it at the back of this video. It should pour up in a minute when I say goodbye, when Nick says goodbye, and then you'll see the video. Have a look at it. Thank you very much for being our guest today. I'm looking forward to next week and what's the market going to prepare for us. Nick, thank you very much. Thank you very much for viewing. See you next week, hopefully. Bye-bye.
Bye-bye.